So picture this. You're behind the wheel of a high-performance sports car, just flying down the highway.
Okay, I'm picturing it.
You glance down at the dashboard, and the speedometer is practically maxed out. I mean, the engine is roaring, the RPMs look fantastic, and by all the metrics right in front of your face, you are having the drive of your life.
Sounds like a pretty great drive.
Right. But out of the corner of your eye, the check engine light is just aggressively flashing bright red. And if you tune out the radio, you can hear this really serious, ominous rumbling coming from deep under the hood.
Yeah, that's never a sound you want to hear.
Exactly. And welcome to today's deep dive into the daily market briefing for April 3, 2026.
Glad to be here. Because that car analogy, it perfectly captures the friction we're seeing today.
Yeah.
Yeah, it's the friction between what your internal dashboard is telling you and the external reality of the road. You basically have domestic economic resilience colliding head-on with international fragility.
Which completely defined the April 3rd market briefing. Today, we have a wildly contradictory day to unpack for you.
You really do.
The dashboard of our economic sports car, the jobs data is flashing bright green.
Right.
But that rumbling under the hood, that's an escalating global conflict threatening to rattle the whole vehicle apart.
Right, and right in the middle of this, the biggest tech companies in the world are making massive infrastructural moves.
Oh, massive.
Well,
While simultaneously dealing with some deep, almost existential market anxieties.
yeah, from bizarre penalties in the memory chip market to a totally hollowed out executive suite at OpenAI.
A lot.
It is. I mean, the overarching theme today is really capital trying to find equilibrium. Investors are basically being forced to weigh the undeniable strength of the U.S. labor force against the massive supply chain disruptions looming overseas.
Okay, let's unpack this macro collision, starting with that dashboard. The massive data drop that dominated Friday was the March jobs report.
And it was a shock.
Total shocker. The expectation from economists was, a modest 59,000 new non-farm payrolls?
Yep, 59,000.
But the actual number came in at 178,000.
Wow.
I know. It pushed the overall unemployment rate down from 4.4% to 4.3% and actually managed to snap a miserable 5-week losing streak for the S&P 500.
It did.
But looking at that massive beat, economists didn't just miss the mark. I mean, their models completely failed to capture the underlying corporate resilience right now.
What's fascinating here is what that specific metric actually tells us.
Walk us through it.
So by looking at non-farm payrolls, we strip out the seasonal noise of the agricultural sector,
Right.
which gives us the purest read on corporate, industrial, and service sector hiring.
Okay.
Adding nearly triple the expected number of jobs in a single month, that means businesses aren't just, maintaining the status quo.
They're growing.
Exactly. They're aggressively expanding their operational footprint. It creates a very solid floor beneath consumer spending power.
I hear that, and here's the thing, it leads to a glaring contradiction in Friday's market action.
How so?
Well, if corporate hiring is outperforming by almost 300%, why did the broader stock market only manage a, quote, mixed performance, according to the briefing? Because normally that kind of data historically triggers a euphoric, across-the-board rally, doesn't it?
It usually does, but this is where that check engine light comes in.
The rumbling under the hood.
Exactly. A strong domestic jobs report signals a resilient U.S. economy, but institutional capital operates on a global calculus.
All right.
And right now, every forward-looking pricing model is heavily weighed down by the escalating U.S.-Iran conflict.
Which introduces the one thing markets simply cannot price in, which is total uncertainty.
Precisely. And, it's important to clarify for everyone listening that the market's reaction here isn't about taking a political stance
Of course not.
or endorsing any foreign policy viewpoint. We are strictly analyzing the economic ripples.
Just the number.
Just the numbers. And the immediate economic reality of tension in that specific region is a massive threat to global energy inputs.
And by extension, shipping lanes.
Exactly. You just cannot sustain a massive market rally when the foundational input for the entire global economy, which is energy, has a volatile, highly unpredictable risk premium attached to it.
And, that volatile risk premium is already showing up in the logistics data.
Oh, absolutely.
Energy stocks were obviously the top market gainers on Friday, directly tracking with the conflict escalation. But the briefing highlighted a detail that really grounds how fast this moves.
The private jets.
Yes. The cost of flying private surged by up to 20% simply due to the immediate spike in jet fuel prices.
Which is wild. And look, while private aviation is obviously a highly concentrated example, it perfectly illustrates the elasticity of variable costs.
Right.
When the underlying commodity spikes, the cost of moving literally any physical object from point A to point B instantly reprices.
Instantly. And that brings us to Amazon, which just dropped what might be the most significant micro-level indicator of the day.
This is the big one.
It is. They are officially slapping a 3.5% fuel and logistics surcharge on all third-party sellers in the U.S. and Canada.
Wow.
And they explicitly cited the Iran war as the catalyst.
See, this is the transmission mechanism right here. This is how geopolitical conflict halfway across the...
Arguably the most optimized fulfillment network on the planet.
Right.
So if their margins are stretched so thin by these fuel spikes that they are forced to instantly penalize their sellers with a 3.5% surcharge.
Then everybody else is in trouble.
Exactly. Everyday consumer goods are about to see a noticeable price hike.
Which raises a really important question about structural inflation.
How so?
Well, third-party sellers on Amazon already operate on razor-thin margins.
Sure.
A 3.5% top-line fee isn't something they can just, absorb. They have to react.
Right, they have to pass it on.
Exactly. They might raise the outright price of the product, but we are also likely to see aggressive shrinkflation.
Oh, the shrinking package sizes.
Yep. Reducing package sizes or utilizing cheaper manufacturing materials just to offset Amazon's new tax.
Which creates this really localized tug-of-war for you and me.
Right.
The labor market added 178,000 jobs, meaning people are securing paychecks. But if everything they buy online quietly inflates to absorb that 3.5% logistics hit, that newfound spending power starts to erode almost immediately.
And we are going to see exactly how consumers are handling that erosion in the coming days.
Because of the earnings reports.
Right. The briefing points to upcoming earnings reports from Levi's and Delta Airlines as the crucial indicators to watch.
Which is interesting because they sit at completely opposite ends of the discretionary spending spectrum.
Exactly. So Levi's is the classic proxy for discretionary physical goods.
Right, apparel.
Apparel is highly elastic. It's one of the first-line items middle-class households cut when everyday inflation squeezes their budget.
That makes sense.
So if Levi's reports softening demand or, points to high inventory buildups.
It tells us the consumer is exhausted.
Precisely.
And then Delta Airlines gives us the pure service and travel perspective.
While being directly exposed to those soaring aviation fuel costs we just talked about.
Right. So if Delta's forward guidance is grim, it means those energy costs are eating into their margins way faster than they can hike ticket prices without killing passenger demand.
It just perfectly illustrates the macro web.
Yeah.
The oil price spikes, Amazon taxes its sellers, Delta struggles to balance its fuel ledgers, and that robust March jobs report suddenly has to carry a lot more weight to keep things afloat.
Yeah. Okay, let's shift gears from physical logistics to the sector trying to build the digital infrastructure of the future.
The tech space.
The tech space, because it is dealing with its own intense growing pains.
Oh, absolutely.
The briefing outlines an industry under immense pressure from macroeconomic challenges and broad geopolitical anxiety. And nowhere is that pressure more contradictory than in the AI space.
No kidding. The tech sector right now is basically a study in capital expenditure versus immediate return.
Right.
We are watching companies pour unprecedented amounts of money into physical infrastructure, while the broader market actively punishes them for not generating the profit margins fast enough.
Microsoft is the prime example today.
Yes, they are.
They just announced a massive $10 billion investment in Japan spread between 2026 and 2029 strictly to build out artificial intelligence infrastructure.
$10 billion.
$10 billion. At the same time, their executives are aggressively touting strong sales traction with their AI assistant, Copilot.
Right.
Yet their stock is dragging because of what the briefing labels, quote, AI anxiety.
Well, AI anxiety is just the market waking up to the realities of capital expenditure timelines.
Meaning what, exactly?
Meaning the initial hype cycle was all about software capabilities, like what can the AI do?
Right, the fun stuff.
Exactly. But now we are in the deployment phase. Building physical data centers in Japan requires massive upfront capital outlays.
Digging in the dirt.
Literally. Laying bricks, securing energy grids, installing servers.
Yeah.
Institutional investors are getting restless, staring at the multi-year gap between that initial $10 billion check and the eventual software revenue.
That makes total sense. But if Microsoft represents the anxiety of physical infrastructure, OpenAI represents utter structural chaos right now.
Total chaos.
The executive flight is alarming.
It really is.
The chief operating officer is shifting out of the role,
Yeah.
and 2 other top executives are taking medical leave simultaneously.
At the exact same time.
That is a massive hollowing out of the C-suite. But in the middle of this leadership vacuum, OpenAI announces they just purchased a media company called TBPN.
Yeah, it's a fascinating juxtaposition of internal instability and external expansion.
Here's where it gets really interesting because, I read this as a panic move. Yeah. OpenAI makes large language models. They are a pure tech developer.
Right.
To lose 3 top executives, including the COO, and suddenly pivot to buying a media property, that reads like a distressed company diversifying because they're hitting a wall with their core product. Are they trying to become a content network to pad their valuation?
No, actually. And if we connect this to the bigger picture, it reveals the actual bottleneck in the AI race.
Okay.
It's not a pivot away from their core product at all. It's a desperate play to keep their core product viable.
Wait, really?
Yeah. The algorithms themselves are rapidly commoditizing. The real battleground has shifted to 2 physical realities.
Fair.
Securing raw compute power, which Microsoft is doing in Japan,
Right.
and securing proprietary data.
Oh, you mean they're buying the media company just to scrape it?
You're buying the archive.
Wow.
Yeah. Large language models require vast oceans of high-quality human-generated text to improve their reasoning capabilities.
And they're running out.
Exactly. The industry is rapidly approaching a data wall, where they are literally running out of open internet to train on.
That is wild.
So by acquiring TBPN, OpenAI secures an exclusive proprietary reservoir of training data that their competitors, like Google or Meta, cannot legally touch. It's an acquisition of raw material, not a pivot to entertainment.
They're essentially buying the oil rights to feed the refinery.
Exactly.
That changes the entire perspective on the acquisition. But speaking of raw materials for computing, that brings me to the most counterintuitive piece of data in the entire briefing.
Oh, I know what you're going to say.
The memory chip paradox.
Yes.
With all this massive infrastructure build-out, you would assume companies making memory chips would just be printing money.
Right, because the demand for data center components has never been higher, conceptually.
Yet, memory chip makers were the top market losers on Friday.
Yep.
The reason given in the briefing is almost absurd. Their memory efficiency improved so much that it is expected to reduce the overall demand for the chips.
It's crazy.
Capitalism is literally punishing these companies for making their hardware too good.
It is. It really highlights a brutal reality of tech hardware economics, which is the replacement cycle.
Break the mechanics of that down for us, because on the surface, it makes no sense to sell off a stock just because the company innovated.
Well, it all comes down to volume projections.
Right, yeah.
When a chip maker achieves a massive architectural leap, drastically reducing the power terabyte.
Like they just did.
Right. The end buyers, like Amazon Web Services or Microsoft, suddenly need fewer physical chips to achieve the same compute goals.
Oh.
They require fewer server racks, less cooling infrastructure.
So the product leap is so significant that it actively cannibalizes the manufacturer's own future sales volume.
Exactly. The buyer gets exponentially more efficiency per dollar, which is great for Microsoft.
Sure.
But the chipmaker's forward-looking revenue gets slashed because the volume of units they will ship over the next 5 years just plummeted. So the market isn't punishing the innovation. It's aggressively repricing the reduced volume of future purchase orders.
The better they do their job, the harder their valuation falls.
Yep.
It's a wild dynamic. So zooming out, we have high fuel costs squeezing logistics, right?
Right.
A booming labor market buffering the economy, AI anxiety dragging down Microsoft, and memory chips being punished for excellence.
It's a messy dashboard.
Very messy. So where is the capital actually flowing?
Well, the briefing provides a very clear map of where capital is finding shelter and seeking yield.
All right.
On Friday, the broader gains were led by small-cap stocks and the energy sector.
Now, energy is a direct hedge against the Iran conflict.
Yeah.
Oil prices surge, the energy sector captures that premium.
Obviously.
But small caps, Why retreat to smaller companies during massive global uncertainty?
Mostly because of their domestic focus.
Oh, interesting.
Yeah, large multinational corporations are highly exposed to global supply chain choke points and currency fluctuations. Small cap companies tend to generate the vast majority of their revenue domestically.
Which ties back to the jobs report.
Exactly. If the U.S. domestic economy is fundamentally strong, which 178,000 new jobs strongly suggests it is,
It does.
then small cap companies are insulated from the geopolitical chaos. They can thrive on that local consumer spending power.
And what about the tech sector? Given the AI anxiety and the memory chip sell-offs, where are investors placing their bets?
The trading volume tells a really interesting story here. The most actively traded stocks heavily featured tech and tech-adjacent funds,
Like which ones?
specifically calling out TQQQ, QQQ, and ROKU.
Okay, let's focus on TQQQ for a second, because that isn't just a standard tech fund.
Not at all.
It's a triple leveraged ETF. If investors are pouring capital into a vehicle designed to multiply the daily returns of the Nasdaq by 3, that isn't cautious optimism.
No, it's not.
That is aggressive risk-on behavior. They are actively hunting for momentum swings.
It shows that despite the broad pressure, the appetite for tech volatility remains incredibly high. But the vital takeaway from the briefing is that the tech sector has become highly stratified.
Meaning the market is finally separating the theoretical plays from the actual revenue generators.
Precisely. The briefing specifically highlights companies like AMD and Apple.
Okay.
Despite the broader AI anxiety dragging down companies that rely on future deployment, AMD and Apple are actually positioned for immediate earnings growth.
So what does this all mean for their strategic positioning? Why are they immune to the anxiety hitting Microsoft?
Because they control the actual monetization layers of the current cycle.
Okay, break that down.
Sure. So AMD is critical to the physical data center build-out. They offer the primary hardware alternative to NVIDIA, meaning they capture immediate CapEx spending.
They're selling the shovels.
Exactly. Apple, on the other hand, controls the consumer distribution layer.
Right.
When these AI features are finally ready for mass adoption, Apple is the gatekeeper holding the ecosystem.
Oh, I see.
They don't have to build the smartest foundational model. They just have to collect the toll when those models reach the consumer's pocket.
They own the toll roads.
Exactly.
So synthesizing all of this, the booming jobs, the rising oil premiums, the tech stratification, we're looking at a market that basically demands precision.
We are fundamentally in a stock picker's market right now.
Yeah.
The foundational U.S. economy is highly resilient, but the days of broadly buying the index and just riding a low interest rate wave, those are over.
Long gone.
Investors have to find the specific companies with undeniable earnings growth potential, the pricing power to survive geopolitical supply chain shocks, and the strategic positioning to actually monetize the structural shifts in technology.
Basically, you have to find the companies that can afford to pay Amazon's 3.5% logistics surcharge without watching their margins collapse.
That is the ultimate stress test in this environment.
To bring it all back together, the April 3rd market was defined by immense push and pull.
It really was.
We saw a surprisingly massive 178,000 new jobs acting as a vital buffer against escalating international conflicts and spiking energy costs. And we looked under the hood of a tech sector frantically building the physical infrastructure of the future while navigating severe internal growing pains, data acquisition battles, and the ironic market punishment of achieving hardware efficiency.
The dashboard is showing incredible speed, but the engine is undeniably running hot.
It is. And I want to leave you with one final thought to mull over today.
What's that?
We watched Amazon instantly react to a global conflict by baking a 3.5% logistics surcharge right into their ecosystem. Overnight. And the broader market didn't panic because the U.S. labor force added those 178,000 jobs to cushion the blow.
Right.
But what happens to the engine of this economic sports car? If the U.S.-Iran conflict drags on, energy prices permanently rebaseline higher, and the labor market inevitably cools down.
That's the scary part.
Will these new corporate surcharges remain a permanent, quiet fixture of our commerce, driving a structural wave of inflation that we simply can't shake?
It's the defining economic question of the year. Historically, once a major corporation successfully passes a cost onto the consumer, they are very rarely in a hurry to relinquish those recovered margins.
Something to keep in mind the next time you see an unexplained fee at checkout.
Definitely.
Thank you for joining us on this deep dive into the numbers behind the news. Keep an eye on the dashboard, but always listen to the engine under the hood. Keep questioning the headlines, and we'll catch you next time.